Good day and welcome to this presentation about FAC4864 Case Study 1 in Tutorial Letter 106. I'm Arman Kombrink and I will be taking you through today's lecture. Before we start, I just want to provide you with some general information with regards to our module, and I just want to say thank you for attending this lecture. It already shows us that you already have commitment to do your best in this module, and I hope you find this session worthwhile. If you have any questions, please contact us. We are here to assist. We know the exams are around the corner, but keep working hard, do your best. So if we jump into it, case study 1, you'll see it starts off with you have 30 minutes reading time. It is very important that while you prepare for the exam, that you also prepare your reading time. This is especially important for our module, where if you've done a couple of questions, you will know that we normally tell you that you have, say, for example, 60% shareholding in the company, and that we tell you you have control, or 30% and you have significant influence. But then again, there's other questions where we just say you have 40% and we don't tell you whether you have control or significant influence. In a case like that, we would normally also provide you with information with regards to what is the relevant activities, or how many directors the company can appoint to the board of directors. So it will actually be, for our module, easy to identify whether it's a potential discussion question coming up, or whether it will be a calculation question whereby you'll be asked to do journals or present the statement of financial position or change in equity, etc. And apart from that, having 30 minutes to read between, say, 6 or 10, 11 pages, you will have enough time to familiarize yourself with the scenario, but also to identify the topics or areas that you actually do well in, and also possibly the areas that you might struggle or forget in the exam. And remember, you don't need to get 100% in the exam. You need to obtain enough marks to pass, and hopefully during today's session we will also identify areas where you can obtain the easy marks to do well. So before we actually jump into the scenario, I would actually advise all or any student during reading time to actually first go to the additional information. You will notice that for our module, that's where a lot of the important information is disclosed or provided to you. So you'll see, for example, additional information number 1. It provides us with what is the accounting policy for the measurement of non-controlling interests. So in this question, the policy is proportionate share of the acquiree's identifiable net assets. That's in accordance with IFRS 319. The standard says, for each business combination, the acquirer shall measure at the acquisition date components of non-controlling interests at either fair value, or, as in this question, the present ownership instrument's proportionate share in the recognized amounts of the acquiree's identifiable net assets. Why is it important? It's because, yes, it might only count 1 or 1.5 marks to calculate NCI for a subsidiary, but where there's maybe a change in ownership interest, as in this question, you need to know whether the goodwill that's attributable to the parent or NCI, should it also be apportioned, or when it's a foreign operation and you have a change in ownership, should you include the goodwill attributable to NCI in the calculation. In addition, if it's a foreign operation, but we'll also get to that later, it might be that you also have to allocate a portion then of the FCTR on the goodwill to either the parent and NCI, or only the parent if NCI is measured at proportionate share. Okay, number 2, the profit after tax for all the companies in the group accrued evenly throughout the year, unless otherwise indicated. This sentence is normally provided in instances where we either acquired or disposed of an entity during the current year, so that you can know that the profit or the retained earnings movement that you have to calculate you can just assume that the profits and losses accrued evenly. Number 3, the appropriate pre-tax discount rate applicable to each company in the group is 9.44%, and the interest rate implicit in the respective leases is 10.25% per annum. So this information actually alerts us that there will be present value calculations in the scenario. We should be very happy if we see that, because it is very easy to obtain those marks whereby we say for future value what is the end period, and of course what is the interest rate. That's easy 1.5 or 2 marks. 4, none of the companies in the group have declared or paid a dividend. 5, the group classifies all interest income as part of other income. Number 6, Joe recognizes any difference between the amount by which the NCI are adjusted and the fair value of the consideration paid or received directly in a changes in ownership reserve in equity. This is a big alert that it's an equity transaction between owners. So this paragraph provides us with information that there will be a subsidiary in the scenario where we have control both before and after the transaction, and then the difference between the consideration paid or received and what NCI changes with is disclosed in a changes in ownership reserve in equity. Number 7, it is accounting policy of Joe to account for investments in subsidiaries at cost. What is useful about this sentence is actually what is not there, and there's no mention of investments in associates or joint ventures, only subsidiaries. Number 8, you can assume that it is probable that taxable profit will be available against which the deductible temporary differences can be utilized. Now, that paragraph or sentence is definitely something that should trigger, oh, I've heard about this, I've read it somewhere. And yes, it is in IAS 1224, which states, a deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable the taxable profit will be available against which the deductible temporary differences can be utilized. So this sentence alerts us to say that if there's a deferred tax asset in this question, or a temporary difference that gives rise to a deferred tax asset, we will be allowed to recognize it as an asset. Number 9, it is accounting policy of the group to account for financial assets in accordance with IFRS 9, which it has to, but then it tells us that the fair value adjustments will be recognized in other comprehensive income in a mark-to-market reserve. Number 10, it is the accounting policy to account for PPE in terms of the cost model. And then 11, there were no changes in the issued ordinary share capital of any of the companies. That also helps us or alerts us that there won't be any change in ownership, equity or interest due to a share buyback or a rights issue, because we know there were no changes in share capital, so we can relax on that front. Number 12 are introduced to 3 new names, Ben, Rob and Mlu, are all acquisitions of a business in accordance with IFRS 3 business combinations. What that tells us or helps us with is we know that it must be subsidiaries. Why? Because IFRS 3 is only applicable once at acquisition date, but also only when we obtain control, either over assets or over the share capital of another subsidiary or entity. So in this case, we can see, because it's 3 entities, probably it will be subsidiaries over which we obtain control. Number 13, it's to do with our tax rates and CGT rates, ignore VAT and dividend tax. And then number 4, assume a normal Mozambique income and capital gains tax rate of 32%. That alerts us that there will be a foreign operation in the question. So now that we know the accounting policies and accounting treatment of the respective items of the group for the financial year, now if we read the scenario about the relevant companies, we know to be on the lookout or how to calculate NCI using proportionate share. If we have to calculate a present value of a contingent consideration or a lease present value, we know what the tax rates are. So let's start. Okay, case study 1. Joe is a leading renewable energy solutions company listed on the JSE. It provides turnkey solar and wind energy services and related products to its customers. Joe acquired various smaller competitors in order to obtain new products and increase market share. Then, the consolidated financial statements for the year ended 30 June 2019 are in the process of being finalized. So here we know what is the year end. It's very important, so we know whatever we are asked to do, be it either journals or financial statements, we know it will be for the year ended 30 June 2019, and that will be our reference where all other transactions or acquisitions will be referenced to. And furthermore, it's in the process of being finalized. So we know the information that will be following, that the consolidated financial statements have not been finalized. So in all probability, this will probably not be required for a consolidated statement of cash flows, because we are still required to either provide the journals or the statements. Then the relevant information is provided below. All the companies in the group have the same 30 June year end. And here we start off with our first company. Investment in Better Electricity Now. Joe acquired its investment in Ben on 1 January 2017. So we can see it was in a prior year. If we assume that it's going to be an associate, joint venture or subsidiary, but because we've read the additional information, we know it will probably be a subsidiary. We know that we will have to allocate NCI their share of since acquisition profits directly in equity, meaning it's retained earnings ACE or revaluation surplus ACE, and in the current year movements it's in P&L and OCI. And then when it obtains 60,000 of the ordinary shares. Can we just assume that we have control if we take 60,000 of the 100,000 shares to say we have 60%? No. You must in the question be specific where you read where it's stated that we have control or significant influence or joint control, or where it's silent, you will probably then be required to discuss whether we have control, whether it should be consolidated or how to account for the investment, etc. Here we are very happy. We can say Joe obtained control over Ben as per the definition of control in accordance with IFRS 10 consolidated financial statements from that date. So yes, we are very happy. We now know that it's a subsidiary and we will have to consolidate. But what is the starting point of the consolidation? It is 100% line by line the trial balance of the parent plus 100% line by line the trial balance of the subsidiary. And this gives us a combined trial balance. So on that combined trial balance, we will have the investment in subsidiary line item, and we will have all the carrying amounts of the trial balance of the subsidiary. Will NCI be on the combined trial balance? No. Will Goodwill be on the trial balance? No. Will any IFRS 3 required adjustments at acquisition be reflected on the combined trial balance? No. That's the reason why we have to then provide the pro forma journal entries, whereby we then recognize the Goodwill, recognize NCI, recognize the IFRS 3 adjustments, and of course eliminate the investment in subsidiary line item. And through the pro forma consolidations, we transform or convert our combined trial balance to our consolidated trial balance. Remember that the consolidated entity is seen as one economic entity which cannot have transactions with itself and investment in itself, and then that's also the reason why we have to eliminate all intra-group transactions, because it cannot have any transactions with itself. If we continue, The details of the consideration paid to the selling shareholders are as follows. IFRS 3, paragraphs 37 to 40 provides us with the information of how to measure consideration, and it must be at fair value at the acquisition date. You must be very happy in the exam if you get a question where you have to calculate what is the consideration, because it is very easy, so it's easy to obtain marks which will give you confidence for the remainder of the question as well. So if we look at the first consideration, a cash payment of 9 million on the acquisition date. So what do we use? Of course, cash of 9 million. But then interestingly, they say the parent utilized its overdraft facility to effect this payment. This overdraft facility carries interest at 21% per annum compounded monthly. Do we have to use this information, do you think? No, we do not have to use this information, as IFRS 3 states that where a liability is incurred, we must only use the acquisition date fair value. So any subsequent cost relating to that liability is not considered when calculating the amount of the consideration paid at the acquisition date. Next, included in the cash payment on the acquisition date is an amount of 14,000 relating to Joe's contribution towards lawyers' fees in accordance with the contract. IFRS 3, paragraph 53 states acquisition-related costs are costs the acquirer incurs to effect a business combination and include finder's fees, advisory, legal, as in this case, accounting, valuation, and other professional or consulting fees. The acquirer shall account for the acquisition-related costs as expenses in the period in which the costs are incurred, with one exception. The cost to issue debt or equity securities shall be recognized in accordance with IAS 32 and IFRS 9. So in this case, we know that the lawyer's fees of 14,000 must be expensed. We know it is included in this cash payment of 9 million, so we know we will have to deduct it. And then lastly, an additional payment of 500,000 due on 1 January. Here we are very happy. We know we have to calculate the present value. We know what the interest rate are. We know the period is 3 years, future value 500,000. It's easy to calculate the present value for our 1.5 marks. Joe also transferred a manufacturing machine to Ben in accordance with the agreement. Ben will use this machine to produce components used in the manufacturing of inverters much faster and at a higher quality. The carrying value of the machine was 2 million on 1 January 2017. The fair value was independently assessed to be 2.5 million on the acquisition date, with the remaining useful life of 5 years and no residual value, which remain unchanged. So which value do you think we should use? So the parent transferred a machine as part of the consideration. Is it the 2 million or the 2.5 million? It is the 2 million. And the reason why we use the carrying amount and not the fair value is IFRS 3, paragraph 38, which states, the consideration transferred may include assets or liabilities of the acquirer that have carrying amounts that differ from their fair values at the acquisition date, as in this question. However, sometimes the transferred assets or liabilities remain within the combined entity after the business combination. For example, because the assets were transferred to the acquiree rather than to its former owners. So in this case, the manufacturing machine was transferred to Ben, the acquiree. And therefore, Joe retains control over the machine. As he has control before the transaction over the machine, and when he transfers it to Ben, he still controls Ben, therefore he still controls the machine, therefore we still recognize the machines only at the 2 million. So now it will be very easy and quick to calculate the consideration paid. There's our cash payment, less the acquisition related costs, our present value of our future payment, and then the manufacturing machine at its carrying amount. And we're on our way with 3 out of 100 marks. if we then continue, the assets and liabilities of Ben were assessed to be at fair value, except for the following. IFRS 3 paragraph 18 states, the acquirer shall measure the identifiable assets acquired and the liabilities assumed at the acquisition date fair values. So we know that all the assets and liabilities are at fair value except for other intangible assets and a lawsuit. So now we will have to apply the principles of IFRS 3 to determine what is the fair value of the underlying or the actual assets and the potential lawsuit to recognize at the acquisition of the subsidiary. So the first one, on the acquisition date, a technology patent and trademark were recognized in Ben's separate financial statements. Only the trademark was considered to be fairly valued. So the patent was registered by Ben on 1 July 2016 before the acquisition date of 1 January 2017. So it's 6 months has passed up to the acquisition date. The cost of the patent recognized in its financial statements was $750,000 on 1 July 2016. The patent had a remaining useful life of 10 years and a residual value of 0. And then at acquisition date, the fair value was assessed at 1.225 million, with the assessment of the useful life and residual value remaining unchanged. Do we know what the carrying value of the patent is at the acquisition date? No, we only have the original cost on 1 July. So for our purposes, we should be happy because it's easy to calculate then what is the carrying amount, and instead of only getting half a mark for the carrying amount, now we know it will be 750,000 less accumulated depreciation for 6 months, whereby it should be amortized over 10 years. And then, because the asset has a useful life, we must remember its subsequent measurement. What I mean with that is, we acquire the subsidiary on 1 January 2017. We recognize the patent at a different value than what it is recognized in the subsidiary's records. Therefore, we'll also have to write a pro forma journal to recognize the additional amortization on the fair value adjustment at acquisition date. Then, the patent is also licensed to a company in Namibia for use in its operations. The terms of the license agreement stipulates that a market-related annual fee of 125,000 is payable on December each year, with the last payment due in 2020. It is not practical to sell the license agreement separately from the parent. So now we've recognized the patent at acquisition or at fair value, but what about this license agreement? Do you think we should also recognize that at acquisition? Yes, it's in accordance with IFRS 3, paragraph B32C, which states, an intangible asset that meets the contractual legal criterion is identifiable even if the asset is not transferable or separable from the acquiree. For example, an acquiree owns a technology patent. It has licensed that patent to others for their exclusive use. Both the technology patent and the related license agreement meet the contractual legal criterion for recognition separately from goodwill. So yes, there we know we will recognize it as an additional intangible asset. It is important to state at this point, you do not need to know each standard IAS or IFRS off by heart. You should just have a very good grasp or overview of the contents of the standard, where you know that there is a section dealing with intangible assets and it provides examples of the different intangible assets. Or, for example, in IFRS 10, that there are lots of paragraphs in its application guidance where it deals with potential voting rights, or that you can have control whilst having not having the majority shareholding. That will assist you when you have to answer a question, especially a discussion type question. If in this instance we don't know whether we will be asked to discuss whether it should this license agreement should be recognized an intangible asset or not, if we assume that it's going to be a calculation question, meaning it's journals or a statement, good exam technique will be, when in doubt, always recognize the asset. You won't be negatively marked if you provide or recognize an asset, you recognize a license agreement, but per the memo it just said, no, you shouldn't have recognized it because of reasons X, Y, Z. Rather recognize it if you are in doubt. And always remember to recognize the fair value. So in this case, do you have a fair value for the license agreement? Not yet. We know what the payment per year is. We know how many years, it's 3, and we know what the discount rate is, so there's another 1.5 marks to calculate the present value. Then if you continue to the lawsuit, we can see a competitor has instituted legal proceedings against Ben. The competitor accused Ben of illegally copying one of its designs and is claiming an amount of 5 million. Then they provide us with some background of how the claim originated, and then even though it can be proven that it was taken, Ben's lawyers are of the opinion that no compensation will be awarded. After taking all the possible outcomes into consideration, including a possible settlement, a fair value of 400,000 can be placed on this claim. IFRS 323 is applicable for this item. It says, the requirements in IAS 37 do not apply in determining which contingent liabilities to recognize as of the acquisition date. Instead, the acquirer shall recognize as of the acquisition date a contingent liability assumed in a business combination if it is a present obligation that arises from past events and its fair value can be measured reliably. So here it complies with that paragraph, so we know we can recognize a contingent liability at 400,000 at acquisition date. Then the paragraph continues to say, due to the highly technical nature of the claim, it was still not finalized at our year end, with the fair value of the claim increasing to 1 million. So there we know that there will be subsequent measurement required. Remember, if it's a contingent liability, the subsidiary will not recognize it in its trial balance. It's only a note in the financial statements, but for our consolidated entity, we have recognized a liability of 400,000. So if the subsidiary subsequent to the acquisition recognize a liability of any amount, in this case 1 million, it means that we will have to reverse the adjustment that was recognized at acquisition. Why do I say that? Is remember that if we start off with the starting point of the consolidation, 100% line by line trial balance of the parent plus 100% of the subsidiary, if the subsidiary has a line item liability which relates to this lawsuit, then if we process the pro forma at acquisition journal, which never changes, where we recognize a liability for the same lawsuit, it will mean that on our consolidated trial balance, we actually will have 2 liabilities recognized for the same lawsuit. And then it says the claim will not be deductible for taxation purposes should it be successful. This has to do with whether you should recognize deferred tax at acquisition or not. Remember, the temporary difference for a liability will, or the tax base for the liability will be the carrying amount less any future deductions that you will be able to claim. In this case, there will be no future deductions. Therefore, the carrying amount and the tax base is equal to each other, meaning there's a temporary difference of 0. If you are unsure in the exam, or you're running out of time, or it's a bit stressful, you can't remember whether you should recognize tax or not, good exam technique will be recognize deferred tax. Again, you won't be negatively marked, but if you make the incorrect judgment call in the exam, it could result in you losing easy half or 1 mark. Then a very short sentence, but it has a big influence. The selling shareholders have contractually agreed to reimburse Joe 90% of any losses as a result of the claim. That is IFRS 327, which states The seller in a business combination may contractually indemnify the acquirer for the outcome of a contingency or uncertainty related to all or part of a specific asset or liability. As a result, the acquirer obtains an indemnification asset. The acquirer shall recognize an indemnification asset at the same time that it recognizes the indemnified item, measured on the same basis as the indemnified item. So in this case, we will also recognize a debit indemnification asset at 90% of the 400,000, which is 360,000. What about tax? It will follow the same tax treatment as the underlying item, in this case the liability. So no tax will be required to be recognized. And then no additional assets, liabilities or contingent liabilities were identified. So now we know they've provided us with all the information at acquisition. So we are now in a position to calculate the goodwill at acquisition, but also we shouldn't forget that some of the fair value adjustments at acquisition gives rise to subsequent measurement adjustments, which we should keep in mind when we are required to do journals or a statement. So here's just a short summary of the license agreement and the present value, which would have been calculated as the 3-year period, the payment per year of 125,000 using the discount rate. There's our subsequent measurement, which is the useful life of 4 years, and since acquisition up to the end of the year it's 2.5 years. So that's the cumulative amortization that was recognized, so we know what is the carrying amount of the license agreement fair value adjustment at 30 June 2019, our reporting date, and then the related deferred tax at acquisition and the deferred tax on the portion of the amortization realized. Why is it 28%? It's because it has a useful life. The carrying amount of the asset will be recovered through use. For an asset which doesn't have a useful life, like land, or if we state for an intangible asset it has an indefinite useful life, the carrying amount can only be recovered through sale, and then the CGT rate will be applicable. So if we just quickly look at the summary of the calculation of our first subsidiary's goodwill, we can see there's the equity at acquisition, easy 1.5 marks for using it. The patent, which was the difference between the fair value and the carrying amount. Deferred tax at 28% because it has a useful life. Our license agreement calculated on top. The related deferred tax. There's our contingent liability, indemnification asset, our consideration that we've already calculated, and then our NCI, which is at 40%, because we know it's proportionate share, and then there's our goodwill. Here's just a short summary of the calculation of the technology patent, whereby it was a fair value that was given. There was the calculation of the carrying amount at acquisition, because remember the patent was acquired 6 months before at acquisition. Then there was a fair value adjustment at acquisition, which is our subsequent measurement. There was 9.5 years remaining since acquisition up to reporting period, and then of course our tax rates. If we continue, then there's information on our second investment, Renewable Optimum Base, ROB, and then they provide us with some background, and then the parent acquired 55% of the issued ordinary shares in ROB on 1 July 2017. Again, that's in a prior year. So again, remember that if there's any IFRS 3 adjustments at acquisition to a depreciable or amortizable asset, we have to take that into account, as well as any sense of or share in the since retained earnings that's attributable to NCI, to also split it between since acquisition up to the beginning of the year, which is directly in equity, SCE, and then the current year profit and loss. And in this case, they tell us for a cash consideration of 12 million. So we're a bit disappointed that we can't get another opportunity to calculate for easy marks. Very important, Joe obtained control, so we know it's a subsidiary from 1 July 2017, and then with these two equity balances. Again, the assets were considered to be fairly valued, except for And we can see plant and factory building. Again, it's IFRS 3 is applicable, which states that all the assets and liabilities must be measured at fair value at acquisition date. So let's start off with the plant. Rob, the subsidiary, owns a plant that's used in the manufacturing of plastic components. Rob leased this plant to an independent third party from 1 July 2015. The carrying amount of the plant at acquisition date amounted to 3.7 million, and the remaining useful life was correctly assessed at 20 years. Again, so it has a useful life. We must remember any fair value adjustment at acquisition, we will have to recognize the depreciation on that as well. So because we remember, we will know it will be easy marks. Debit depreciation, credit accumulated depreciation, debit deferred tax, credit income tax expense. The fair value of the patent was estimated at 4.5 million on that date, based on the market-related rentals. So we know the fair value adjustment will be 800,000. The terms of the agreement are as follows. So you can see the lease started on 1 July 2015 for 10 years, so it's not the full useful life of the plant. There's the lease payment date, the lease payment amount, and then we can see similar market-related rentals, it's different. So we know that then gives rise to a favorable or unfavorable component. In this case, it gives rise to a favorable component because we are receiving a higher rental than what the market similar or market-related rental would have earned us. So, what do we do with this information with regards to the lease agreement that we can see there's a difference between the lease payment and the market-related rental? We go to IFRS 3, paragraph B42. In measuring the acquisition date fair value of an asset, such as a building or a patent that is subject to an operating lease in which the acquiree is the lessor, as in this case where it's the subsidiary's plant and it's leasing it to somebody else, then the acquirer shall take into account the terms of the lease. The acquirer does not recognize a separate asset or liability if the terms of the lease are either favorable or unfavorable when compared with market terms. So what does that mean? It means that the fair value adjustment of the plant at acquisition date will be the 800,000 plus the favorable component of 500,000. So at acquisition date, the plant fair value adjustment will be 1.3 million. So this paragraph, IFRS 3 B42, specifically states that we will not recognize a separate asset for this favorable component. It is capitalized or added to the fair value adjustment of the plant line item. And then it tells us the plant is correctly classified as PPE. Then for the factory building, one of Rob's factory buildings was considered to be undervalued at the acquisition date. The details of the building were as follows. We have the original cost and the cumulative depreciation recognized. So we know the carrying amount would be 3,225,000. The fair value 3.4. So we know that there will be a fair value adjustment at the acquisition date. And then there's a residual value that we need to take into account when calculating depreciation, and then there's a useful life as well, which we should be very happy about because we know that there will be a subsequent measurement required to depreciate the fair value adjustment at the acquisition date. But then the next paragraph tells us that Rob, the subsidiary, sold the factory building to Joe, the parent, on 1 July 2018. The factory building was correctly assessed to have a remaining useful life of 24 years, which is 1 year less than what it was 1 year prior, so we know it hasn't changed, but the residual value has increased. These estimates have been assessed and confirmed. So here we should remember that there's actually two portions for the factory building. One will be the at acquisition adjustment, recognition of the fair value adjustment that we also will have to depreciate for 1 year up until the date of the sale. But then we have to really focus at the beginning of the reporting period for the current year, 1 July 2018, the subsidiary sells the building to the parent. So the parent will then have a building or factory building at 3.6 million in its trial balance, and it would have recognized the depreciation for that year. But if we look at the consolidated entity, that building was in the group before the transaction and in the group after the transaction. So the depreciation that the parent has recognized when it acquired the building on 1 July 2018 will have to be reversed. It is, from a consolidated point of view, actually as if that sale hasn't taken place. But because our starting point is 100% trial balance of the parent plus 100% trial balance of the subsidiary, our combined trial balance will include the depreciation on a higher amount than what it should be in the consolidated records. So therefore we'll have to do an adjustment. If it doesn't make completely sense, hopefully it will when we take a look at the calculation. So there's the at acquisition adjustment. There's the calculation of the parent, which bought the building on the start or at the beginning of the current year for 3.6 million. There's the calculation for the current year's depreciation. So we know that our starting point for the consolidation recognizes the factory building at 3.4,722,917. But from the group's perspective, or the consolidated perspective, the fair value was 3.4 million at acquisition date. Then less the depreciation for 2017, less the depreciation for 2018, we get to a consolidated carrying amount for the building of 3,171,042. So on our combined trial balance, our starting point for the consolidation, we have the factory building at this amount, but it should be at this amount. Therefore, we know that we will have to decrease the factory building in our consolidated financial statements with 301,000 to get this 3.4 million that it starts with on the combined trial balance to the 3.1 million, which it should end with on the consolidated trial balance. And then, of course, the deferred tax at 28% because the carrying amount is recovered through use. We have worked through the at acquisition adjustments for Rob. We are also now at a point where we can also calculate the goodwill for Rob at acquisition date. Here's also just the calculation of the plant, where it was the fair value adjustment at acquisition, the 800,000, and then the favorable component, which gives us our total fair value adjustment, and then our subsequent measurement. It's just very important that we still split the depreciation between the two components, meaning the fair value adjustment on the plant and the favorable component. And the reason is the plant is depreciated over its useful life, and of course the favorable component is depreciated over the remaining lease term. And then with the goodwill, there again is equity at acquisition, which is given, so it's an easy mark. The plant, which we've calculated the fair value, easy half mark. The deferred tax at 28%. The building related deferred tax, there's our consideration that was given, easy mark. And then our NCI, which is at proportionate share, another easy half mark. And then in the scenario, it also provides us information on an intergroup lease agreement. On 1 January 2019, Joe and Rob entered into an agreement whereby Joe leased an empty office building from Rob for a period of 5 years. So here we can see it is during the current year, and our year end is 30 June, so we know it's for the last 6 months. The rentals are payable annually in arrears and were determined at 250,000 for the first year with an escalation of 6% per annum thereafter. The details of the fair value and carrying amount are as follows. The fair value and carrying amount amounted to 2.75 million on 1 January 2019, and then the remaining useful life and residual value were correctly assessed at 25 years and 500,000 respectively. And then the fair value of the office building increased to 50,000 at year end. The office and factory buildings on which a rental is earned are classified as investment property in the accounting policy of the Joe Group. This is very important. So this actually tells us that in the separate records of the subsidiary, he would have classified this office building as investment property in accordance with the fair value model of IAS 40. So that means he wouldn't have depreciated the office building over the 25 years. He would have recognized the building at 2.75 on 1 January 2019, and at year end it has increased to 50,000, so he has an investment property of 2.8 million in his separate financial statements. However, when we get to the consolidated entity or group, which is seen as one entity, now the parent is the one occupying the building and it becomes owner occupied. Therefore, it cannot be investment property anymore. It reverts back to PPE. And we know the accounting policy for the PPE is at cost. So in this case, we know we will have to de-recognize the fair value adjustment of 50,000. There cannot be an investment property of 2.8 million in the financial or the consolidated financial statements. There will be a PPE line item office building which must be measured in accordance with the cost model, which will be the 2.75 million depreciated over 25 years, of course, less the 500,000 residual value. Then the Joe Group elected to early adopt IFRS 16 leases. What that means is that Joe has an operating lease on the office building. But in accordance with IFRS 16, he's now in a position where he would have recognized a right of use asset for Joe. So if we want to calculate the value of the right of use asset at year end, we start off with cash flow 0, which is 0. We know that because they told us the rentals are payable annually in arrears. So it's CF1 250,000, then it escalates with 6% annually for 5 years. There's our interest rate implicit in the lease that we know we have to use because we've already read it in the additional information. And then there was our asset on the date that the lease was entered into, and then it's amortized over the lease term of 5 years, but it's already been used or leased for 6 months. And then we have what is the right of use asset at year end. So here we can see the value of the office building, if it's investment property, is the 2.8 million. If it's owner occupied, it's depreciated, and the value at year end is 2.7 million. Then we come to our last subsidiary for the purposes of this question. There are 2 additional investments or the details provided, but based on how the information is provided, you would have noticed that no financial information was provided to be utilized along with the remainder of the information of the group, meaning that there's no information that you could use to prepare journals or the financial statements, and that for those 2 entities it will in all likelihood either be a disclosure or discussion type question. So Joe diversified its operations into another African country by acquiring a 75% interest in the ordinary share capital of MLU on 1 January 2018. Again, that's in the prior year, at the fair value per share. So we can see no consideration was provided, but they do tell us that they used the fair value per share, and we know how many shares were bought. 75% of 100,000, which we can also use because in the additional information it told us there were no changes in the share capital for any of the respective years. Joe obtained control, so therefore we know it's a subsidiary. IFRS 3 is applicable once on the date that we obtained control. All the assets and liabilities were considered to be fairly valued except for machinery. Now, IAS 21 paragraph 47 says, any goodwill arising on the acquisition of a foreign operation and any fair value adjustments to the carrying amounts of assets and liabilities arising on the acquisition of that foreign operation shall be treated as assets and liabilities of the foreign operation. Thus, they shall be expressed in the functional currency of the foreign operation and shall be translated at the closing rate. Now, what that means is on the subsidiary's separate trial balance, the machinery in this instance will be carried at its carrying amount, which in this case is 2,050,000, and subsequent to the acquisition date, the foreign operations subsidiary will continue to depreciate based on this value. But IAS 21 paragraph 47 says, yes, we fair valued it, but that fair value adjustment, the 2.3 million less the 2.5 million, 2,050,000, should also be depreciated in the foreign currency, the MZN. And the same principle applies to goodwill, that goodwill will also be always translated back to MZN, and then when the consolidated financial statements are prepared, it will be translated back to Rand using the appropriate closing rate on the reporting date. The machinery had a remaining useful life, so we know that there will be subsequent measurement, and we know the tax rate will be 28%, it will be 32% in this case, and a residual value of 0 at that date. No additional assets or liabilities or contingent liabilities were identified. So at this point we are able to calculate its goodwill because we can calculate the consideration. We have the net asset value on the date of acquisition plus the fair value adjustment, and we know that NCI is measured using the proportionate share. But then, do you remember that in the additional information we read that where there's an owner's equity transaction, the difference between the consideration paid and received and the amount with which NCI changes is disclosed in a change in ownership column? Here is our information relating to that. The management decided to realize a portion of its investment in Imlu, and on year end, so we know for our purposes we do not need to split the portion of the profit attributable to NCI using different shareholding rates. We know we can finalize the accounting, and then at year end only we are required to process the change in ownership transaction, and they disposed of 15% of the shares at its fair value. And then, very important, they still had control over Imlu after the disposal of the shares. IFRS 10B96 states, when the proportion of the equity held by non-controlling interest changes, like in this case, it reduces with 15%, an entity shall adjust the carrying amounts of the controlling and non-controlling interests to reflect the changes in their relative interest in the subsidiary. The entity shall recognize directly in equity any difference between the amount by which the non-controlling interests are adjusted and the fair value of the consideration paid or received and attributed to the owners of the parent. In this case, it is also very important to mention that because we know that NCI is measured at proportionate share, if the parent has goodwill in this instance, we must just ensure that we do not take it into account when we calculate what is the net asset value on the date of the change of control, to calculate what is the portion of the 15% that must be attributed or allocated back to the parent. And then we have the respective balances on the acquisition date, beginning of the current year, end of the current year. The following exchange rates were applicable at the respective dates. IAS 21 paragraph 38 states, assets and liabilities are translated at the closing rate, so that's the year-end rate. All income and expenses are translated at the transaction date. For our purposes, it's impractical to provide you with what is the revenue or cost of sales or other expenses for each day and provide you with 365 different rates to translate. So for our purposes, the income and expenses are translated at the average rate, and then the paragraph continues to state that the exchange differences, the FCTR, it's recognized in OCI. So you can see at acquisition date, that's our rate. We have the average for the period since acquisition up to the beginning of the year, which we will use to translate the retained earnings. There's our closing rate for 2018, or for our current period, it will be the opening balance. There's our average rate that we use for the profit for the current year, and then our closing rate, which we will then use for the current year to calculate or to translate our net assets and translate our goodwill, and then of course also the date on which the change of control happens. And then they also provide us with the fair value of the share price, 190 MZN, to calculate our consideration paid, and at the end of the current year to calculate the consideration that we paid for or received for selling or disposing our 200 or our 15% shareholding at 250. So if we take a step back and calculate the goodwill of our foreign operation at acquisition, we first calculate what is our fair value adjustment at acquisition. It's 250,000. Using the exchange rate at acquisition, we know it's 52,500 Rand. It's also just interesting or important to note in this case whereby we say 250,000 times the exchange rate for the Rand. How do we know when to multiply, when to divide? It depends on how this ratio for the exchange rates are provided. It says one foreign currency equals this in Rand. So any amount in MZN, for example, this 190, if you want to get to the Rand, you multiply it with the exchange rate. If it was the other way around, if we say MZN equals 1 Rand, then it would have been divided. So for our purposes of calculating goodwill, we could have stopped here. It's the 52,500 less the tax rate at that date. There's our consideration using the at acquisition rate, the fair value, our NCI at proportionate share. There's our goodwill at acquisition. But then this calculation also provides the subsequent measurement whereby the machinery was depreciated up to the beginning of the year, and then for the current year, there's a closing rate for the current year, the deferred tax, and then this is our calculation of the consolidated carrying amount for the machinery at the beginning of the year, at the end of the year, and then right at the bottom we have our goodwill at acquisition. But remember that because goodwill does not appear in the separate trial balance of the subsidiary, it only originates in the at acquisition journal, then goodwill originates in the consolidated financial statements, meaning then that the FCTR on goodwill has not been recognized yet. And to recognize NCI then at goodwill at year end using the closing rate, we get to an amount of 704,700 Rand for goodwill. So then we're also done with our third subsidiary. Then if you continue with the question, you see it's financial information, and they provide us with an extract of the following balances from each company. We can see it's non-current assets. So it's property, plant and equipment for each entity, the parent plus the 3 subsidiaries. There's investment property, other intangible assets, financial investments with a footnote that says the financial investments include both investments in subsidiaries and financial investments classified in accordance with IFRS 9. So remember that the parent then in this line item will include its consideration paid for its interest in Ben, in Rob and Mlu, and then this paragraph states that where there's a residual value, it's relating to other financial investments classified in accordance with IFRS 9. Because remember that the parent can only recognize the investment in Ben, Rob and Mlu at cost in its separate financial statements. And then here's our deferred tax asset, and remember that in the additional information they told us that there will be sufficient taxable profits in future years against which this deferred tax asset will be utilized. And then very interestingly, the following amounts have been correctly determined for disclosure in the consolidated financial statements of the Joe Group for the year ended 30 June 2019. And we can see that they've provided us with what is the NCI balance at the beginning of the year for Ben and for Rob, but not for the foreign operation in Mlu. And we can also see that the total comprehensive income, that is the profits and loss plus other comprehensive income, that's attributable to the NCI of Ben and to Rob is also provided, but again, not of Mlu. So at this point, this was then our last bit of information for this question. So based on all the information that has been provided, that we've also been through, without looking at the required, would you have been able to determine what type of question might have been required? Yes, pro forma journals, it's always an option when it's a consolidation question, especially in this instance as well. The only difference here is that there's not a lot of profits and loss items that was provided in the scenario, that we haven't received the profit, or we haven't been provided the profit of the parent or of 2 of the 3 subsidiaries. They actually only told us what is their share attributable to NCI. And the problem with how they presented this, that it's total comprehensive income, is we are not able to split what is the portion attributable to NCI P&L or NCI OCI. These 5 line items or non-current assets, you would probably assume that the required will be for present the non-current asset section of the consolidated statement of financial position for the group. And if we then continue to the required, that is the case where they say prepare only the non-current asset section. It's very important then, even though there's information may be provided for share capital or for loans, or you have the retained earnings balance, do not use or provide those line items. Do not waste unnecessary time completing information that was not required and that will not earn you marks. The important thing with regards to the presentation of a statement of financial position, where you are not required to present equity, is remember you will then not need to calculate all the profits and loss or prior year up until the beginning of the current year, movements in retained earnings or portions attributable to NCI, because how the statement of financial position is laid out, if it's only the assets and liabilities, you should only calculate what is the closing balances at year end. You are not interested in what was the depreciation for the current year. We are then interested in what is the depreciation since acquisition up until the beginning of the year. Then you don't need to split it to say retained earnings, accumulated depreciation, depreciation, accumulated depreciation. You can just calculate the total amount. So again, don't waste unnecessary time splitting it since acquisition up to the beginning of the year and then calculate for the current year. You can just calculate one amount in total to calculate the balances. Always pay special attention to the please note. In this case, comparative figures are not required. So, where do we start? Always go to your IFRS or IAS book. In this case, it's a statement of financial position, so it's an IAS 1 in the implementation guidance paragraph 6, where they provide us with a template for the statement of financial position, specifically our non-current assets section. If it was a statement of cash flows, then go to IAS 7 implementation guidance. So I would suggest then going to your book, writing down this format, maybe leaving a line open in between in case you remember or realize that there's items also required to be disclosed, not mentioned here. So if we then continue to what the solution looks like, you will see that yes, again, there's property, plant and equipment, goodwill, other intangible assets, investments in equity instruments. The 2 additional ones, it's investment property that's added in our solution, so we've left the line open, and of course the deferred tax asset that's also recognized under non-current assets. And we don't have an investment in associate line item as provided for in the implementation guidance. I included the non-current liabilities just so that you can see here the deferred tax is disclosed, but in our instance, because it's an asset, it will move to the non-current asset section. So if we start off with the first line item, property, plant and equipment, you'll see it counts 15 marks, but immediately you can earn 2 of the 15 without even almost lifting a finger, but of course you have to write down the 4 amounts, but all 4 of these amounts were given. So how do I know it? Where's the information coming from? You will see at the bottom, here was the financial information where they provided us with the property, plant and equipment for each. And very importantly, blue, it was provided in Rand, not in the Mozambican currency. Otherwise, you would also have been required to first translate it back to Rand. The starting point for a foreign operation consolidation is still 100% trial balance of the parent plus 100% Rand trial balance of the foreign operation. So now you may ask me, but if the foreign currency trial balance balances, but now I have to translate the income and expenses at a different rate to the assets and liabilities, the at acquisition equity, I have to translate it at acquisition. How will that trial balance to use as my starting point to get a combined trial balance? Of course, that's where our FCTR balance comes from. That is the balance required to balance the Rand trial balance of the foreign operation, because it will not balance because I use different foreign exchange rates to balance or to translate the foreign currency into Rand. So if I then continue with the rest of the PPE calculation, you'll see there's our intergroup transaction between Rob and Joe for the lease of the building. There was plant of Rob. We'll go through each one now on the next pages, factory building and the machinery. So if we start off with the intergroup rental, we've already seen this calculation. Where did we get the information? In the scenario where we've seen it was owner occupied, 2.7 million. So that was not included in my PPE. Remember, it was in my investment property. That's why I have to, it's a positive, I have to add it to my PPE. And then the right of use asset we will use when it gets to the investment property. The plant of Rob, remember, it was fairly valued. There was a favorable component that was subsequently measured, and we got the carrying amount at year end of 1,095,000, which you have to recognize. And then there's our deferred tax that we will recognize against the deferred tax asset line item. And here was the information that was obtained from. Then again, if you proceed to the factory building, here's the information in the scenario. We've already seen this calculation whereby the parent that has bought the factory building from the subsidiary has recognized it at year end at this value, 3.4 million. But because at the consolidated level, it was in the group before the transaction and it's in the group after the transaction, we will continue using the original value of the factory building when we acquired Rob to calculate what the carrying amount for that building should have been, the 3.1 million. Therefore, we know we have to reduce the factory building balance in the consolidated records with the difference. And then the related tax consequences for our deferred tax asset line item. Then it's the machinery of our foreign operation, where we had the fair value adjustment at acquisition at the closing rate. We've had the subsequent depreciation, and then at year end we know what is the carrying amount of that fair value adjustment. Using the closing rate, we get our Rand value, and then of course the deferred tax will be recognized in the deferred tax asset line item. If we then continue to our second line item of our solution, it's the investment property. The first two balances were given, so we're very happy. Another one easy mark. There's our intergroup building between the subsidiary and the parent that's now recognized as PPE, so we have to take it out at its fair value from investment property, and we've also have to take out the right of use asset from investment property as well. and it's IFRS 1656, which states if a right-of-use asset meet the definition of an investment property, the lessee shall apply the disclosure requirements in IAS 40, meaning that right-of-use asset would also have been disclosed in investment property. Our next line item is then Goodwill, which consists of our acquisitions of the 3 subsidiaries, Ben, Rob and Mlu, which we've already been through the calculations, but I'll just show them again. It's very important at this point also just to mention that if there was an investment in associate and we paid more than our proportionate share, meaning there's goodwill, would that goodwill have been included in this goodwill calculation? No, because remember, any goodwill on an acquisition of an associate is assumed to be or is already subsumed into the investment in associate line item. We don't recognize the goodwill in a separate line item. It is part of our investment in associate line item. So here's our calculation of the goodwill. First of all for Ben, but like I say, we've already been through it. There's the equity at acquisition, the fair value adjustments at acquisition, what we paid for it, NCI's portion, and then goodwill. The calculation for Rob, again, equity at acquisition, the fair value adjustments and deferred tax, consideration paid, NCI, there's our goodwill. Very easy marks to obtain. And then lastly, for our foreign operation, there's the equity in the foreign currency using the at acquisition exchange rate. There was our machinery, fair value adjustment at acquisition using the foreign operations tax rate. Our consideration paid, NCI is at proportionate share. There's our goodwill at acquisition date. But remember, because we are disclosing goodwill in the statement of financial position at year end, 30 June 2019, the goodwill that was recognized at acquisition must still be adjusted to the closing rate. So this will be the cumulative movement, meaning it's the movement since acquisition up to the beginning of the year and for the current year. So that's why it's the difference between the at acquisition rate and the closing rate. The next line item is our other intangible assets. The first one was for Ben, it was given, so very happy, easy half mark. Then there's the technology patent and the license agreement. Both had a useful life. Therefore, there was subsequent measurement required. Therefore, we have to adjust the at acquisition fair value adjustment less accumulated amortization up to the end of the current year, which gives us our adjusted carrying amount, and of course our indemnification asset, which relates to the lawsuit, which in the scenario it's stated as increased to 1 million times 90% because it hasn't been settled, so we still recognize the indemnification asset at year end. Just a recap of our technology patent, the at acquisition adjustment, there's our subsequent measurement, it had a remaining useful life of 9.5 years. It was 2.5 years since acquisition up to the end of the current year, 30 June. That gives us our carrying amount. And then there's our deferred tax implications that will be taken into account in our deferred tax asset line item. For the license agreement, that was our present value calculation for 1.5 marks, payment of 125,000 N3, and then our discount rate. There's our amortization for 2.5 years since acquisition of 1 January 2017 up to 30 June, and it has a useful life of 4 years. And then the related deferred tax implications as well. And then if we move on to our financial investments, the only company with a line item was the parent Joe. But as I stated, remember included in that figure is the amount of the consideration paid for the 3 subsidiaries. So that is then what we are left with as our investments in equity instruments at year end. And then lastly, our deferred tax asset. Again, you must be very happy that we can just use these 4 amounts that was given. Not difficult at all. We get another 2 marks, easy peasy. And then there's just the tax implications that's taken into account for the underlying items. The technology patented would have been deferred tax at acquisition, less the tax implications for the subsequent measurement. The same for the license agreement, same for the plant, factory building, and then the machinery of the foreign operation. So to summarize, read the required very carefully. Do not waste time answering the incorrect thing or providing comparative figures or providing the full statement of financial position. Read the required 2 times or 3 times. It is very important for any type of question. Imagine for a discussion type question, as my colleague commented last week, for IFRS 11, if it's stated that you can already assume that it is a contractual arrangement, you must then continue to discuss the classification, but you actually then start to discuss whether it is a contractual arrangement. You're wasting unnecessary time and taking time away from those items that you will be able to earn the easy marks for and that you can actually do. For a statement of financial position or change in equity, etc., use your IFRS as your starting point. Remember, exam circumstances, exam stress, it can lead to even anybody forgetting simple things. You use that as your starting point. Leave a couple of lines open in between each one if you're afraid that not all the items are there, and you can slot in if you identify anything else, but it will just ensure that, for example, you don't forget to disclose goodwill or investment in associate, etc. Of course, use the information in the question. Do not discuss anything else or make up information or assumptions to say, oh, but I assume this must have been the case. Use the information in the question. What I mean with the next block, start from the top of the statement, is if you've used your IFRS as your starting point and the first line item is PPE, then start off with your property, plant and equipment, as we've done in this presentation, and then take into account, okay, what was all the amounts given? Where else was PPE then information provided? For the factory building or for the plant or office building, and then use that in your calculation. And as soon as you're done with PPE, transfer your answer to your solution and to ensure that you use all your calculation. Or you should start at the beginning of the scenario. And what we mean with that is you start on page 1 of the scenario of the given information. You already have your template for a solution written down, meaning you have your PPE, you have investment property, goodwill, other intangible assets. And then for the first paragraph, you can see, for example, it impacts the goodwill. Because we have to calculate goodwill. You know, I calculate goodwill, I use it in my calculation. I write it in my goodwill line item C1. Here's the first calculation. Then you see, but there's also IFRS 3 at acquisition adjustments. It impacts intangible assets and it impacts PPE. And then you calculate those related amounts and then you slot it in to next to PPE, other intangible assets. And then what that scenario helps with, or that method helps with, is it will ensure that after you've read and used all the information on page 1, you don't need to go back to page 1. You can then just continue to page 2. And if you're done with page 2, you don't need to go back. You continue to page 3. So what that will help is that at the end of page 6, you know you've used all the information at all the places where you've had to, and then you can just ensure that all your calculations you have transferred to your answer and that you can hopefully earn all the marks that you can. That method also helps to identify maybe if you struggled with the whole calculation where it was an operating lease for the lessee as well, and you say, I don't know what to do, I don't know where to start. You can just make a note next to that in your scenario and then say, leave that till end, I'll come back to it. And then you continue to the next paragraph, which hopefully you are able to do, and it's maybe something easier or simpler where it's, say, a fair value adjustment of the machinery. And you can do that and then you continue, and then after you've again read through all the scenario and used all the information you see, but I still have 5 or 10 minutes left, then you can go back to those paragraphs that you haven't used the information yet. But you will see in all probability, or most likely, you will reach the end of your time before even having time to go back. But because you didn't waste unnecessary time attempting something that you can't do, it maybe counts 3 or 4 marks, but you didn't waste 15 minutes, you still get only 0 or half mark. It will just ensure that for the remainder of the paper you're not under stressed, you still have time, you had good time management for each question, because the majority of the questions do have easy marks available for each one. Yes, there might be a short question that seems very difficult, or maybe there's a 10 mark question that you feel I can get 10 marks for it, but if it's the last question, you only have 3 minutes for it, of course, then you won't be able to get 10 minutes. So you have to really practice doing questions under exam conditions. We know time is a factor, but really try to practice as many questions as you can under the exam conditions. And of course, mark yourself very strict. And where you see you lack the technical knowledge or practice, then go back to your textbook or tutorial letter and obtain additional information there, or of course contact your lecturer for additional help on that as well. I've already mentioned this. Use all your calculations. Remember, calculations only marked if used in your answer. This is especially true for a student who uses the analysis of owner's equity. I personally also use it. The problem with that is that where it's completed 100%, a lot of time could be wasted, and then there's not enough time to actually transfer the calculations to your answer. And the other problem that we've encountered is, again, students complete it 100%, but they don't know where to use the amounts in their answer. So if that applies to you, I would definitely suggest taking a question where there's a analysis of shareholders' equity, and then see if you can determine where each amount must be used in a journal, in a statement of financial position, just to ensure that you know that when you get the required, you know which amounts to use. Next, and I've already touched on this as well, is stick to your time limit. Ensure that you are able to attempt all questions to earn the marks for the areas that you do know well and that you can score marks. Remember, earn the marks to pass. If we then continue to part B of question 1, prepare the consolidated statement of changes in equity for the group for the year ended 30 June 2019. And very important, always when it's a statement of change in equity, read very carefully what columns are required. You only need to present the following columns: changes in ownership reserve, foreign currency translation reserve, and non-controlling interests. Again, do not waste time providing the share capital column, retained earnings, revaluation surplus, total equity columns. Only answer what is required. And then, of course, again, please note, comparative figures are not required, meaning we only need to start our solution with 1 July 2018 and then the movements for the current year. So again, where do we start? The same place, IS1 Implementation Guidance 6. They provide us with a very comprehensive statement of change in equity, columns wise, where it's share capital, retained earnings, etc. But we know we only need to do those 3 columns. And then they provide us with some information with regards to what is required in the statement of changes. For our purposes, we know there were no changes in share capital. We know there were no dividends declared. We have the total comprehensive income for the year. For the 2 subsidiaries, we know we require the foreign operation one. Okay, and then there was a transfer to retained earnings from the revaluation surplus, which was not applicable in our instance. What is applicable, of course, is the disposal of, or partial disposal of, a subsidiary. So if we just quickly look at the summary of the solution, you see here's our 3 columns. We start at the beginning of the year, the balance is provided. There's our total comprehensive income for the year. We know, again, no dividends were paid. There was our partial disposal of our interest. So we know NCI will increase because we disposed of our share. The change in ownership interest will be the difference between the amount that we received and the amount that NCI changes with. And then because it's a foreign operation, we also have to transfer a portion of our foreign currency translation reserve to NCI as well. But more on that later. So if we start off with the first one, the non-controlling interest opening balance. Remember, in our scenario, they provided us with the opening balances for Ben and Rob again, so that's an easy 1 mark. And then for our foreign operation, we already calculated the NCI at acquisition when we calculated our goodwill. So then it's only our since acquisition share of profits and loss. And the information that we get for the profit was the movement in the retained earnings up until the beginning of the year, 14.9, and then of course the movement in the machinery that was adjusted to fair value at acquisition date, and then the different rates that was used. Okay, then after the profit calculation, there's also included in the NCI opening balance the share of the since acquisition up until the beginning of the year FCTR, which we'll get to now, and then we get to our opening balance NCI. For the foreign currency translation reserve, we know what is the net asset value at the beginning of the year. We know what is the value of the machinery, so we use the exchange rate at the beginning of the year to get to our net asset value in Rand. We know what was the at acquisition equity of Lu. We used it to calculate the goodwill. We know what was our retained earnings, and then of course the difference to get the trial balance to balance is then our FCTR 316,900. We've calculated the goodwill at acquisition, the goodwill up to the beginning of the year using the at acquisition rate and the closing rate at the beginning of the year gives us our movement FCTR for goodwill, and then the FCTR attributable to the parent is split between 100% for goodwill because NCI is measured at proportionate share, and the FCTR that was used to balance the foreign exchange trial balance of the foreign operation, and NCI their share of 25%. Then the total comprehensive income attributable to NCI. We were provided information for Ben and Rob in the scenario. And then, so it's only for our foreign operation that we have to calculate. Again, the current year's profit, it was the movement between the closing balance retained earnings and the opening balance, which gives us our profit. And then we've adjusted it with the depreciation on the machinery and the related tax consequence. It's very important to also just state where you have to use the movement in retained earnings to get your profit for the year. You have to be on the lookout for any dividends that was paid. So in this question, there was no dividends paid. But if dividends were paid, remember that dividends reduces your retained earnings closing balance. So if you want to calculate the profit, you will first have to add back any dividends that was declared during the current year to the closing balance retained earnings, and then thereafter subtract the opening balance retained earnings. Then there's the FCTR movement for the current year, which we'll get to now, and then we have what was our total OCI attributable to NCI. The OCI movement for the year was the net asset value of the foreign operation at year end, what was the machinery's value at year end. Using the closing rate, we get our Rand value. Then we know what was the opening value for the net assets, the current year's profit, and there we have what was our closing or the current year's FCTR movement. Then we calculate what was the FCTR on goodwill movement, and then if we split it between the parent and NCI, we get their respective balances. Then lastly, when we come to the change in ownership calculation, remember that was on the last day of the current year. The fair value of the consideration, they told us we sold 15% of 100,000 shares, it's 15,000. The fair value on the disposal date was 250, and then the exchange rate at year end gives us our consideration, easy 1.5 marks. And then the amount with which NCI changes, we use the net asset value of the foreign operation at year end, excluding goodwill, times 15% to get to what is the value. Then very importantly, we also have to attribute a portion of the FCTR of the parent now to NCI. So our total amount with which NCI changes would have been their portion of the net assets that they now get, so it's times 15%, and then the portion of the FCTR of the parent now attributable to NCI. So if we look at our solution once again, you will see there's our opening balances, there's our total comprehensive income for the year, there's the amount with which NCI changes, 542563, because we have to disclose the movement in or the transfer of the FCTR in a separate line item. So 542 plus 147 gives us our 689766 that we've calculated. The reason why it's included there is, remember that this net asset is already translated at the closing rate, so it includes the FCTR as well. So at this point, I want to say thank you for attending this lecture. Keep working hard. Please contact us if you need any assistance or any advice. We are here to help, and we'll see you soon.